Unity stock is the topic of today's presentation. And if you're somebody that's invested in used stock, you'll want to watch this because we raised some concerns that have come up with the company since the last time we checked in. Now, we're actually long Unity stock. So whenever we're invested in a company, we don't look at their financial results every quarter. That creates a lot of noise. We like to check in once a year unless there are some major events happening, and last year there were. So you can see on the right-hand side here a number of videos that we published, and there are accompanying articles as well. And then on the left, this is an article that we published yesterday, and it says Unity stock, some concerns around their metrics. That's what we're going to talk about. Now, the last time we left Unity, you can see here on the right, it says Unity IronSource merger, good or bad? Well, at that time, it certainly looked like a good idea. So Unity software dominates the mobile gaming niche. We had come up, well, you'll find all kinds of estimates about the size of mobile gaming. This one's quite small, $76 billion. Others are much larger than that. But the point is that Unity is considered to be the leader. So 71% of the top 1,000 mobile games were made with Unity, with 94 of the top 100 game development studios being Unity customers. So pretty much everybody uses Unity. And they took a major step towards becoming even more entrenched by acquiring IronSource, whose platform powered 87 of the top 100 mobile games. So it's easy to see that there might be synergies between these two companies, and that was the purpose of the acquisition. Here's a chart taken from Mashable that shows just how big mobile gaming is relative to other types of gaming. You see handheld consoles, home consoles, PC, Mac gaming. Look how large mobile gaming is. Well, that's because everybody carries around a smartphone these days. Now, Unity's thesis in a nutshell, they're a clear leader in what they do, and we invest in leaders. They're a play on AR/VR, though one could argue those haven't done much, and the same would hold true for the metaverse. But if there were to be opportunities in those areas, then Unity would be a major player. And of course, digital twins, that's something that Unity's working on, and we'll touch more on that. Basically, it's a SaaS firm with upside for ad spending. Now, that's a double-edged sword. So when their clients do good, they do good, but they also experience downside, as we're going to talk about today. This statement here from Unity is pretty compelling. Through virtually every major crisis, the game industry has grown. Through recession, it grows. Through catastrophes like 9/11, the game industry had strong weeks immediately following. It's what people do when they're frustrated. People like to play games. Now, the M&A event that took place, we looked at IronSource when that deal had been announced. That's the last time you get to look at because they were a publicly traded company. They were actually a SPAC, interestingly enough. That's the last time that you get to look at their books. So they had gross margins of 84% versus Unity at 77%. Gross retention rate of 98%. That's very strong. Only 2% of clients canceled in 2021. Their platform's sticky. Then Unity said they would buy back up to $2.5 billion in shares over the next 24 months. That's to make up for the dilution, and we'll touch on that. And then this bullet point here is notable. The two largest Unity shareholders, Silver Lake and Sequoia, invested another $1 billion in Unity in the form of a convertible note with a conversion price of around $49 per share in 2027. What that means is when that note comes due in 2027, that these firms have the option to accept Unity shares as payment at that strike price. So what they're counting on is they believe at that time in 2027, shares of Unity will trade much higher than that. So they're going to capture more upside than the 2% interest rate they're charging Unity. So for both parties, that seems to be pretty good. And that dilution that takes place in 2027, at least based on today's numbers, somewhere around 5%. So doesn't seem like a bad deal for both parties. And that deal closed in the fourth quarter of 2022. So let's talk a little bit about the share buyback. During the fourth quarter of 2022, that's last year, Unity bought 42.7 million shares back at an average price of $35 per share. Well, it trades around $45 today. Certainly that wasn't close to 52-week lows, but you always want a firm buying back their shares when they're reasonably valued, right? You don't want them buying overpriced shares. with that buyback, they returned, and you can do the math there, $1.5 billion to shareholders as part of a $2.5 billion share buyback program. Whether or not they continue to buy that additional $1 billion in shares remains to be seen. You see here, it says we closed 2022 with $1.6 billion in cash, and that's right around what they have now. That would mean a net of $1.1 billion outstanding. So in addition to that $1 billion convertible note we talked about due in 2027, they also have a $1.7 billion note due in 2026 with a very high strike price. So it's likely that they'll need to come up with money for that strike price, somewhere around $300 a share. So let's talk a little bit about the cost of IronSource. Here you can see, just going into their 10K, it clearly states the common stock they issued in connection with the acquisition, so somewhere around $2.7 billion they paid for IronSource, and there's the shares that they issued, so they diluted investors. Then they did that buyback. You see right below that, the 42.7 million shares they bought back we just talked about. So there's two ways that you can look at it. The buyback decreased outstanding shares by almost exactly 10%, and the net increase in outstanding shares following the buyback. In other words, the dilution that took place for the acquisition of IronSource after that buyback net was about 24%. And you can see here that we've noted the shares that will come due from that $1 billion convertible note will incur a 5.5% dilution on top of shares outstanding right now. As we said, that $1.7 billion note's not likely to trigger because of a $300 plus stock price conversion. Now, one thing that's quite notable in this acquisition, take a look here. So Goodwill, that's when a company acquires another firm for more money than the assets they're purchasing, which simply means they believe that the value of the synergies is going to be more than what they paid. And this is always a good deal for the company being acquired. Here you can see that intangible assets, those are things that you can't put a real value on, plus goodwill totaled around, $2.8 billion. That means that they paid a lot for IronSource, and they're going to need to make sure that they get that value. Now, when we look at the benefits from a revenue growth perspective, it's not very impressive. So between 2021 and 2022, here you can see these two segments. And we've written, as I said, extensively about Unity. You can go back and read our pieces and learn about how this business works. But basically, there's two segments here, Create being their SaaS subscription model for these game developers, and Grow being this ad spending bit where they take a chunk of the ad spend that takes place on their platform. So you can see here that the Grow solutions, that's where all the IronSource revenues went into that bucket. So after the acquisition, the downside, the weakness in their advertising spend means their Grow segment grew just 12% in 2022 following that acquisition. So not very impressive. What's worse is that, you look at what they're guiding towards for this year, and it's somewhere, around 50% revenue growth or something like that. But when you look at the pro forma, basically taking into account the fact that IronSource was around since 2021, and then looking at the growth based on that, then they're only going to see 3 to 9% pro forma growth this year. That's not very good. And the question here is, could Unity's organic growth be plateauing? And we'll look at some numbers that might suggest that in a second. But one problem that we encountered that I think I'm only now realizing this is that this firm doesn't provide quarterly earnings presentations, or at least they haven't now for 3 quarters. So you can see here their financial summary table on the website. And the last time they had an earnings presentation was in Q2 of last year. And now, this last quarter, first quarter of 2023, they have a webcast, which is a bunch of talking heads, and an earnings transcript in which the analysts and the company sit there and drone on about AI nearly the entire call. And you also have a shareholder letter that actually contains some meat. So retail investors or anybody that's invested in this firm is forced to go and dig into 10Q or 10K filings to try to find insights when it should just be a basic requirement of any investor relations team that they provide a deck for investors that shows key metrics like these out of that shareholder letter, these random shareholder letters they provide. We see some weakness here that's quite concerning. So the two numbers on display here, the line, the yellow line there reflects dollar-based net expansion rate, net retention rate, whatever you want to call it. This is the extent to which their existing customers are spending more over time. It's on the decline. And you can see a bump there in Q4 2022. Well, those actual numbers, excluding IronSource, would have been 109. So you can see that blip is just an exception and they're on the decline, a consistent decline, along with the blue bars, which show customers spending more than 100K. Now, one missing piece of information here that Unity doesn't provide, IronSource did, it was 98%, is gross retention rate. That tells us whether or not they're seeing customers cancel and go to competitors. So could this be a lagged response to the quote-unquote bear market? And we talk about bear market. Actually, it's quite interesting. It's been 1.5 years roughly since the bear market started. Here's a chart that shows the QQQ, basically the performance of NASDAQ. And I think Elon Musk said it right. Was it yesterday? He said, so one day it seems like the world economy is falling apart. The next day everything's fine. I don't know what the hell's going on. I'll be totally frank. Agreed. So is this a dead cat bounce, or are we on the cusp of the biggest bull market ever seen because of generative AI? Well, we would lean just based on a lot of the warning signs in the global economy. We'd lean towards the former, that this is a dead cat bounce, but we've learned, if anything, over time that trying to predict where the market goes is a fool's errand. So we'll leave it at that and say that when you invest in a firm, you want to invest in companies that will do good during recessions, during bull markets, or bear markets. So when it comes to Unity, clearly, they're facing some effects of that recession. When you look at IronSource's metrics prior to the acquisition, here's a couple slides. One shows their net retention rate on the left. That looks like snowflake. Those are very strong numbers. And look at their quarterly customers over 100K on the right, growing over time. These appear to have had very little impact on the combined company. Now, when you look forward, the combined firm talks about how they expect to grow in an overall down market, gains in ads enabled by the merger. So they specifically say that they expect revenues to grow as a result of this merger, not just cost savings. And they say here regarding the Create segment, which is that SaaS component, they expect growth in China, growth from some pricing actions, and globally in digital twins. Well, we're particularly interested in that because it's diversification outside of gaming. But one problem is that when Unity stops providing investor decks, they don't give us slides like this one, which was from the last investor deck that they provided, was in Q2 2022. You can see where they said revenue outside of games as a percentage of Create, that SaaS segment, increased 7 percentage points to 40%. That's pretty notable. We'd love to see what that looks like going forward and to see that increase over time. There's a reason why they provided this slide, and that's because investors are interested in that. And the fact that they stopped showing these investor decks every quarter is very concerning. So just to conclude, Unity's acquisition of IronSource could be a solution to their slowing organic revenue growth. Or it could just be poor timing in which all the benefits from that acquisition are eroded by a weak ad market, which is what they're telling us. Now, we believe 2024, that's next year, will be a key indicator of success. What sort of growth will we see next year now that the dust has settled from this acquisition? Be very wary of management sweeping revenue growth under the carpet and focusing on profitability instead. And you sort of see some hints of that in their earnings call. They need to resume these investor decks and show us key metrics so we're able to track their progress without having to do tons of due diligence. Now, this $78 billion mobile gaming total addressable market, it's probably far bigger than that, plus the digital twin opportunity is very compelling. It should provide plenty of upside for a firm with just several $billion in revenue. So we still have strong convictions about the thesis. We're just questioning whether or not this acquisition is going to add as much value as we're told. So I'm going to put up another video here that you might be interested in. Before you watch that, please click the Analyze logo on the right, subscribe to our channel, support our work. Thanks so much for taking the time to watch this today.